I think that's what we're all looking at, is to find out what's that tipping point to really start to have the overall effect where earnings could start to get impacted. 3.2, 3.23 is not, in my view, where it is. But I think as we start getting closer to 3.5, 3.75, we could start to see a little bit of an impact towards earnings. However, I don't think we're going to, I don't think we're there yet, nor do I think we're going to get there right away.
Kirk, on Friday, Bob Pisani was going through a number of reasons that yields are rising, saying it's okay. They're doing so for the right reasons. Things are good. Corporate earnings are strong. The economy is strong. The Fed is doing what it should to make sure that we don't overheat. Can we exist in an environment where rates can rise and equities can as well?
Sure we can. I think the thing to watch is the credit markets. Credit markets have been doing extremely well this year, almost better than the equity markets. Credit spreads are very tight. So I think the thing to watch is with the impact of a rising interest rates, especially on the short end of the curve, what's that going to do to the credit markets, both to the consumer and to the institutional market in terms of the cost of borrowing?
Picking up on that point, I mean, at what point do investors need to really start paying attention to things like debt to equity? Things that when interest rates were very low, it didn't really make a difference. But maybe at this point in time, we have to be concerned about leverage balance sheets and the ability to pay off that debt.
No question, there's a lot of leverage in the system. And I think that, on both the consumer side and on the borrowing side, you have to be careful. The other thing I think you can't forget is the amount of money that's in the system because of the tax cuts. And the other thing I think that's very interesting is you now have a restrictive Fed in the U.S. while you still have accommodation overseas, which explains the strong dollar. So a lot of different contrarian forces going on, and we'll see what happens to the credit markets.
So Jeff, it seems to me that what's getting teed up here is a tussle between rising rates and rising corporate profits. Who wins?
Well, right. I still believe right now we're, kind of maybe put a little bit of a baseball analogy together and say, I think a lot of folks think maybe we're in the top of the ninth here. I think we're really in the sixth inning because we have strong GDP, we have strong earnings. Yes, some of it coming from tax reform. We have strong consumer confidence. People are spending, buying cars, and whatnot. So I think there's a strong economic and fundamental economic backdrop that we've just been running down this last 2 weeks, this yellow brick road of tariffs, trade, and interest rates. That once earnings season kicks off, I think we're going to have another strong earnings season. I think when manufacturing comes out again, we'll see the manufacturing again coming in strong and high. I do think the fundamentals of this market will show that the stock and the equity market still has more room to run, and certainly want to be invested. I think there's also a disparity between the U.S. market and the international markets right now, where if you have a diversified portfolio, say 60-40, you're so overly, most of the time you're going to be, you're looking at your returns right now saying, where am I? I'm missing something. And that's because of the underperformance in international, the bond market, where the U.S. market's really the only sector that's doing really well.